Welcome to the Multifamily Investing Show, your source for market forecasting, investment, and operational strategies. Your host is Michael Becker, a principal at SPI Advisory and a Dallas-based multifamily operator who has purchased over 10,000 apartment units and manages over $1 billion in assets. Join us as Michael interviews the top players in the world of multifamily brokerage, investment, financing, and economics. And here is Michael Becker.
Welcome to the Multifamily Investing Show with Michael Becker. I'm your host, Michael Becker. It's our first episode of 2021, episode 6. I'm excited to start the year off right. We have one of my longtime friends, Brad Sumrok, joining us today. Brad, thank you for joining us today.
Hey, I'm excited to be here and kicking off 2021 with you, Mike.
Yeah, thanks, Brad. So Brad is the founder and president, I guess, of Brad Sumrok's Apartment Investor Mastery Group. It's a multifamily mentoring program, ecosystem. It's a lot of things. Maybe Brad, tell us a little bit about kind of what you do for a day to day, and then we'll get into your history and have a nice conversation today.
Yeah, well, thank you. And everything started with me being an investor. And I still say, look, I invest first, and then I just teach people what I do. So first deal was back in 2002. I bought a 32-unit building. And this was after struggling in corporate America with not 1 degree, but 2 degrees, engineer, MBA, always wanted to climb that corporate ladder, and be like a C-level person in the corporate world, and never really got there. And after considering studying for the LSAT and becoming a lawyer, I actually picked up the Rich Dad, Poor Dad book. And that book changed my life. It taught me about being a business owner. It taught me about being an investor. So I sought out mentoring. I sought out a peer group so I could be around people that were doing what it is that I want to do. And 8 months later, I went out and bought this 32-unit building. Within 3 years, I was making almost twice as much with my apartment investments as I was with my job. So back in 2005, I quit my job. And then I just started doing more and more deals. And eventually, along with my wife, launched what we call Sumrock Multifamily Mentoring. We don't go by that. That's actually the name of our company, but it's really Brad Sumrok, and then our programs are under the Apartment Investor Mastery name.
When did you start your program? It's what, 2012?
2013 was when we did our first training event and had our first what we call students.
Yeah, that's awesome. So I've known Brad a long time. When I was a banker, I used to loan to a lot of his students at the time, and so I've seen you guys kind of grow quite a bit. So a lot of people that are watching this might know who you are, but a lot of them wouldn't. So maybe talk a little bit about kind of your program. Before we're starting, you kind of gave me a couple stats. You didn't really start tracking the kind of volume you guys did, but just kind of give perspective for people. In 2015, which is the first year you said you started tracking stuff, you guys ended up doing your students, excuse me, not you, but your students purchased 26 properties. Total deal volume about $140 million. Average deal size about $5.4 million. Fast forward to the last full non-COVID year, I guess would be 2019. You guys did nearly 60 deals, about $790 million, and the average deal size was about $13.5 million. So kind of nearly tripled the average deal size, and then more than almost quadrupled your deal flow. So maybe talk a little bit about that. That's kind of really what I want to talk today. So before we kind of get into the growth of the program and kind of the impact that you and maybe some similar kind of investment clubs have had impact on the market, maybe talk a little bit about like who's your average student, where do they come from, what's the avatar of someone that comes to you, and why are they seeking you out?
Yeah, so in the beginning, and it still is part of our avatar, in the beginning, it was like I was 18 years ago. It was somebody with a professional job, typically a college degree, somebody that makes, back then, high 5 figures, 6 figures. Now, of course, with inflation, it's a 6-figure income earner. It could be an engineer, an accountant, maybe a doctor or a lawyer. But somebody that, just like I was 15, 20 years ago, just wasn't where they wanted to be financially. And to me, it's all about financial freedom. And then the vehicle is apartment investing. And I think apartment investing is one of the best ways to become financially free, from the cash flow, the upside, the tax savings. So, again, the avatar is somebody that's in what Kiyosaki would call that corporate rat race and wants to get out. It expanded though, because now we found that there's a lot of people that are already doing real estate investing. So anyone that's already doing real estate, I'd like to have them look at the benefits of multifamily real estate, because just like you, Mike, and you and your company have what, like 8,000 or 9,000 units? I lost track.
Yeah.
I mean, you're a smart guy. You probably analyze a lot of different types of commercial real estate or real estate, and honed in on multifamily. So if people are out there doing single family or small multi-units, duplexes, fourplexes, my message to them is simple. You don't have to start off small. You don't have to graduate from single family or duplexes and fourplexes to multifamily property. So those are my main students, or people that are doing small multifamily or maybe single family and want to go bigger faster, or people that have a good job, they have some money saved, and they have aspirations to get out of corporate America.
So what does the program look like today? You guys have certainly, I think I might have went to one of your first events you ever did when you launched the program in 2013. What did it look like then, and then kind of what does it look like now as far as number of people, average deal size, as I mentioned, is like tripled basically in the time you've been doing it. Why is that? What's really kind of happened in the growth of your company over the last 8, 9 years now?
Yeah, I kind of look at it like a snowball rolling downhill.
Yeah. And
in the beginning, we had, in our programs are essentially the same, except we've just added more. We've added more content. We've added some higher level programs. We've added the mastermind. But in a nutshell, our programs are really designed for two types of investors. Number one, they're designed for people that want to be passive investors. And, I know a lot of passive investors are like, hey, I just want to invest. I don't want to be educated. But I think the best investor is an educated investor. And then when we look at the whole SEC requirements, if you're a non-accredited investor, you need to be sophisticated.
Yep.
So our passive investor program, which we call the Foundations Program, is really designed to enable people to become sophisticated investors, enable them to make intelligent investment decisions for them and their families. So whether it's myself or you or someone out there or one of my students that puts together an offering and puts it in front of them,
Yeah.
that they understand it. They know what a cap rate is, and they know what vacancy rate should be, and they understand bad debt, and they understand NOI and debt service coverage ratios and all those types of things. And a lot of people, as you know, just invest in things because they meet somebody and they like them and they trust them. And that could be a disaster.
Sure.
So by understanding all the foundational concepts of apartment buildings, they're able to be a better investor. So that's part of my program. And then the other are people that want to put together deals as a syndicator. And, as you know, syndication is just a way to group money together in an SEC compliant fashion and buy bigger deals and have more control and make more money and help more people. So I would say about half of my students come in, want to be passive. The other half come in and they're ready to go and start syndicating deals. And I already said half and half, so that leaves out anybody else. But there are a percentage of people that want to do their own deals. There's some people that just don't want to syndicate, and so they come into the program too. And me and my team will personally work with them. And there's a lot of people that start off as passive, and then they realize that the people they're investing with aren't any smarter or higher skill sets. They just made a different commitment.
Yep.
That they said, hey, instead of me being passive, I'm going to be an active syndicator. I'm going to be a general partner of a deal. So we have a lot of people that start as passive and then ultimately end up syndicating and putting together their own deals as a GP.
So you guys really started out in 2013. Like I said, your average deal is $5 million, give or take. Now the market's really grown as part of that, but I kind of view you're kind of, as I mentioned, the investment club has really been really has kind of changed, revolutionized, especially the workforce housing space of our industry. And I kind of view you almost like the center of the bullseye when it comes to the investment club space. I don't mean to make it too generic with the investment club, but the mentoring program, and it's really not so much the education that you provided, but it's providing a platform, or kind of the ecosystem, as you call it, where you get a lot of passive investors and sponsors and the various vendors, from debt to property management to all the various vendors it takes to put one of these deals together, and you put it in a common place for people, and they're able to come in and really kind of have not quite a turnkey solution, but everything they need to get a deal done is located within a room. And then that's really allowed these people to do bigger and bigger deals. So I don't know if you maybe have an example of one of your students, don't necessarily name names, that maybe started out a few years ago doing something a little bit smaller, and then kind of where that's progressed. That might be a good kind of a case study to what's really kind of changed in our marketplace in general.
Yeah, and Mike, just you hit the nail on the head. Like, my vision when we put this company together was because I've been investing, okay, and I know what it takes to put a deal together. So yes, we offer mentoring, but so much more. And my vision and what I think we've done successfully is to identify everything somebody would need to be a successful multifamily business owner, business operator, and bring that into the Sumrock programs. And so we've done that, whether it's, the capital raise, the mentoring, the underwriting, the tools, the checklists, a source of equity, a source of debt, the relationships with brokers, relationships with providers, so that somebody that's new or relatively new or doing smaller deals could come in and kind of level that playing field and be taken seriously by the brokerage community and by the selling community. A great example of just in a few short years, one of my students, their first deal was a $5 million deal. It was a C class. It was right here in East Dallas. I think their first equity raise was maybe $1.5 million. They were very nervous about, raising that kind of money.
Yeah.
I mean, like, seriously, if you're new, where else do you get $1.5 million in equity, right? And so we were able to leverage the relationships we had with the broker, and they awarded it to us or my students in this case, as a first-time buyer group. And they've done 9 transactions now in the last 4 months. The last time I heard, they shared with me they're making $42,000 a month. By the way, their net worth has went up from about $1 million to over $6 million. And their most recent deal was a $33 million transaction that they just closed at the end of 2020.
Yeah.
So that's a progression that is possible, and that's not a unique situation. Another student of mine, her first deal was a $4 million deal. She did $1 million equity raise. Fast forward over 4 years, her most recent deal was $42 million.
Yep.
So within 4 years, she went from doing, deals under $5 million to deals over $40 million.
And that's and to Brad's point, especially in Dallas, Fort Worth, and now we're kind of growing. We talk about that a little bit. It's been a pretty large percentage of the workforce housing deals I've traded is students of yours. I mean, it's really been a pretty big impact. I don't know the exact percentage, but enough to move the needle. And so you're pretty well known here in Texas, and Dallas, Fort Worth, and now in the kind of the other majors, really kind of grown there because you were based here. You are based here. Your company's based here. This was the first market that we kind of had a big impact. And as we kind of were about to record, we're talking, we just recently both saw an article where Dallas Fort Worth has taken over from New York City in 2020, just took over 2020 as having the most transactional volume in commercial real estate. So I've always thought of Dallas as kind of the center of the multifamily universe, and maybe now we literally are the center of the multifamily universe. So you have had a pretty big impact within our marketplace. But if I'm out in North Carolina or the Midwest somewhere, I might not have never heard of you, but now you're starting to see some of your students I know in Phoenix and Atlanta and maybe some other markets. Talk about kind of the growth of the geography of your program and some of the impacts of some of the other markets you have students actively buying deals in.
Yeah, and again, I started in Dallas, and I didn't do a research and say, hey, I'm going to locate myself in Dallas because this is the best place to be. I was in Dallas.
Yeah.
Okay. I started my investment career in Houston. I moved to Dallas in 2008 and started buying in Dallas. And so I don't believe things in life are a coincidence. I believe I was here for a reason. But the point is, we started in Dallas when we launched our company in 2013. So I believe that I know Dallas as good as anybody, especially the B and C class. And when we started, we were basically buying deals in Dallas and maybe a little bit in Houston and Central Texas. And now, as you pointed out, not only do we dominate Dallas. I mean, Dallas is #1 market for apartments. We're #1 workforce housing buyer group, the Sumrock group. We are very well known in Texas. And, Phoenix, you mentioned Phoenix, Atlanta, and the suburbs around Atlanta, Jacksonville, Orlando, Tampa, we're well known there. I have deals in Jacksonville. I have deals in the Tampa Bay area. I've owned property myself in Colorado Springs, and now we have students that buy in Denver and Colorado Springs. So those are the markets that were well known. And if you think about it, Mike, 95% of deals are traded through brokers.
Mm-hmm.
And, I know your audience isn't necessarily the newbie audience, but if you are a newbie and you're listening, this isn't a no money down type of deal. We're buying businesses, 10, 20, $30 million businesses, right? So it's all about the relationship with the brokers.
Yep.
And so where I'm going is brokers now in North Carolina that are with CBRE, Newmark, Northmark, Marcus and Millichap, they're learning about us through our relationships with the brokers in the markets where we're very well known. And now we're leveraging those relationships to penetrate new markets because Sumrock students are all over the country. So that's how we're doing it.
So if I'm a first-time aspiring apartment owner, what are some of the challenges that they face that you've kind of observed over and over? Is there any sort of common things, common concerns, or fears that these people have that you guys kind of help overcome? And maybe talk through that a little bit. How do you get your first deal done?
Well, there's so many I could think of, but I mean, one is just the mindset. Like there are people that just, one of my students that I could think of has done a bunch of his own deals, but he's never syndicated the deal. So even though he has a lot of experience buying apartments and managing them, he's never used other people's money in a syndication. So that's what he wants to learn. And he was blown away because he was like, Brad, I came to your event in December, and even though I have like 600 units of my own, I met people that are raising $10, $12 million like on their first or second deal, and it blows me away how confident they are. So part of it's the mindset.
Yep.
For me, the mindset was I got to get a job and work hard and get good grades, and that's not and climb my way up the corporate ladder. So there are people that have been taught they should start with a duplex or a fourplex, for example. And then they listen to me, and not only to me, but also my other successful students. And they could walk out of one of my weekend training events thinking, oh my God, I got to think bigger. So the mindset is one, but once you make that decision to be an apartment investor, which I think is a major step to success, by the way, is just making that decision. Then you have challenges like, where would I get the equity? People always say, oh, if you have a good deal, the money will come. Well, try raising $2 million when you don't have an investor database or you don't have a track record. Okay, so the money doesn't necessarily come unless you can surround yourself with people that are ready to invest, that are educated. So we've solved that problem. When you go to get say you're buying a $10 million loan, you're going to need $3 million of equity. So we've solved that problem by putting together hundreds and hundreds of people that want to invest. We solved the debt problem. You go out and get a $7 million loan. You need net worth and liquidity requirements. A lot of these syndicators buying a $10 million deal don't have a net worth of $7 million where they could be the sole guarantor on the loan. So we could combine people to be loan guarantors. We get people, and again, I don't make these introductions. I just facilitate the networking events, right? And so through them participating in the in-person and now our virtual networking events, they can meet each other and build investor databases, build up loan guarantors, meet providers, meet people that can do their loans, do their legal, get their insurance, everything they need, okay? And then, of course, there's me and my team that holds their hands through the process. So, mentoring, underwriting, a second set of eyes, all those things are parts of the problem, okay? So, to answer your question, the debt, securing the debt is an issue for people, and we're able to help with that by meeting lender requirements and having multiple guarantors on a loan. An example was I just had 5 students team up to be GPs. So there's 5 GPs, they have 147 investors, but they took down like a $36 million deal. And they needed to have a combined net worth of, $25 million.
Sure.
And so they have 7 or 8 people that are loan guarantors that are able to make that up. So we're able to, assist with that problem. And then just the peer group. Again, when you're around, Tony Robbins says success leaves clues. I don't know who else said if you become the 5 people that you spend the most time with. So by immersing yourself around people that are doing what it is that you want to do, that confidence is going to rub off,
Yep.
but also the content and the roadmap and the blueprint, so that not only are they getting that blueprint or that roadmap from me and my team, but they're getting it from the other people in the ecosystem.
So you've been around a lot of people. You've seen people succeed. You've seen people be less successful. What common things do you see for more successful investors? What do they do that people that maybe aren't as successful or fail in this business? What are some of the differences in the way those two different groups act?
Well, I think one is focus. I know that's one of the things that I like to think that has led to, the level of success that I've had is we say no to a lot of things. I call it shiny penny syndrome.
Yeah.
And so many people come to my events, they get excited, they start underwriting deals. And look, we've had people that have got their first deal closed within 3 months. But sometimes it doesn't work that way. How many deals do you look at, Mike, before you could buy one? I mean,
dozens and dozens.
Yeah, and there's no rule of thumb. Like, I'm never going to say you need to look at 100 deals to buy one. Like,
Yeah.
I've looked at 3 deals this year and bought one. Okay. But the more focused you are, the more honed in you are. Then when you find something you like, you go after it harder than anybody else, right? But also focus, meaning like I have very few successful students that are doing 5 things besides multifamily, meaning they're not, opening up a jewelry store, they're not owning car washes, they're not doing self-storage, and then doing multifamily.
Yeah.
Most of my successful students made the decision to be really honed in and dialed in and focused on multifamily. So that's number one. And I think number 2 is they partner. And whether it's an informal partnership, say with a management company or a lender or a lawyer, but they're not out there shopping every loan they do. They're not out there shopping every all the different providers. They meet people that they know could get them to the finish line,
Yeah.
and then they build up this relationship, because relationships matter in this business.
For sure.
So especially when things are tightening up, and loans need to get done and things need to get across the finish line. So those relationships matter. So it's the people that understand the value of relationships, that focus, and then they also realize that, talking about partnering too, is when they do form partnerships, they're forming partnerships with people that have complementary skill sets. So like if you're a good promoter and capital raiser, you're not going to want to partner with somebody that's a great promoter and capital raiser.
Right.
You're going to want to partner with somebody that's a little bit more focused on the nuts and bolts of the deal. So, I was talking to a friend of mine, and I don't mind saying he's a friend of mine, Grant Cardone. I think everybody knows who he is. And everybody knows him for Cardone Capital and all these deals he's putting together, whether you love him or hate him. But everybody knows Grant Cardone. But one of the things he told me is he's got a partner in Cardone Capital. Nobody even knows his name, but that's the guy that does all the technical stuff and the asset management once they close the deals. So Grant's strength is out there. He's promoting the deals and he's raising the money. So I think it's important to identify what you bring to the table. Mm-hmm. And as you form business partnerships, you partner up with people that have complementary skill sets. I'm sure you have some examples of that in your own company.
Oh, sure. Yeah, that's exactly. It wasn't as well thought out as I would like it to have been at the beginning, but exactly how we set our business up. My partner, Sean, is very analytical, very genius when it comes to chopping up numbers on underwriting deals, where he's not the promoter or the marketer. Not that I'm like as Mr. Outgoing here, but I at least competent and capable delivering the message out to the marketplace. So that's definitely something I've observed when people that are a little bit more successful tend to partner up, scale. It's a team sport, as we all like to say. You can't do everything on your own. You need to rely on your vendors, your management partner, whether that's you or when you're vertically integrated or getting a professional third-party management company, lawyer, lender, all those people, and then a roster of passive investors. If you're going to be a deal sponsor, is
imagine you had to do all that yourself.
I know.
I know. Imagine one of the things that you do really well is, your promoter doesn't just have to mean, being a badass on social media,
Sure.
right? But it's networking. It's like you love to go to networking events. You build relationships with brokers. Everybody knows who you are and they know what you can do and they know what you've done. So when there's a deal that comes available, you're probably on the top 3 of the list to say, hey, if this is in Becker's wheelhouse, then this is the deal
Hopefully.
Mike's going to want to look at, right?
That's great. Yeah.
But that's a skill set.
Yeah.
And if you had 2 other business partners and they were and you were all out at the same networking events, but nobody was tight on the analysis, the underwriting, the budgeting, all that kind of stuff. I mean, you wouldn't have a successful organization.
Yeah.
So that's the key, is finding complementary skill set people to partner with, being extremely dialed in or focused. You don't have to say no to everything, but you can't be. I don't want to say you can't be, but I mean, multifamily investing needs to be in your top 2 or 3 things that you're doing with your life.
Yeah. What risks do you see in today's marketplace? We just came off of a very choppy year, very uneven year. And maybe before we get to that, maybe anything that you're reflecting back on 2020 now that we're into 2021, any lessons maybe kind of learned from 2020, and how are we going to apply those going forward in 2021?
Yeah, so lessons learned. It's funny looking back, and people ask me a lot too. They ask me about some of the biggest mistakes I've ever made, and one of them was just not buying more. And I look back and say, okay, like the world shut down in the middle of March, or basically the whole world shut down.
Yeah.
And our Q1, not just for me personally, but in our event mentoring company, but in the supporting our students buying deals, our Q1 was on pace with 2019. Our Q4 was on pace with 2019. It's those 2 quarters in the middle.
Yeah.
And things shut down, and a lot of things shut down because sellers were hesitant to sell, because buyers, at least in my view, buyers wanted the discount. And what happens is when there's a lot of uncertainty, okay, sellers, for the majority of sellers, looked at their numbers, say the first 3 months of April, May, June, and most sellers saw very little change to their financials. Yep. I mean, I'm sure you could concur with that. Maybe 1 or 2%,
yep.
Right? And as we know, in multifamily, these properties are valued by income. So if your income stays the same, why would you sell at a 10 or 20% discount? But there were a lot of buyers out there that, because of uncertainty, not because the numbers changed, but because their confidence changed. And then they started hedging against, well, what if this goes on for another 2 years, and then there was the whole election wild card.
Yep.
And so now that election is behind us, the pandemic still isn't behind us. So to me, the lessons learned from 2020 is, look, the fundamentals for apartments hasn't changed. And one of the lessons that I've learned from 2020 is just how resilient multifamily really is.
Yep.
I mean, hotels, no.
Yep.
Office, no. Retail, no. And then if you look at some of these other, businesses like restaurants and things like that, where some people's life savings have been wiped out, well, all that money now from these other commercial assets like office and retail, a lot of that capital is now pouring into multifamily.
Yep.
So I think the demand for multifamily from the investor side is higher than ever before, but also from the supply and demand of the residents, right? What happened with construction during the pandemic? Did it increase or decrease? It decreased. So there's less projects coming online.
Yep.
So now and prior to the pandemic, there was a shortage of housing, especially workforce housing.
Yep.
So now that shortage there's an exclamation point on it. And that shortage to me now has actually now moved into the A class.
Go ahead.
Well, the A class was traditionally something I would avoid, just because number one, I was less familiar with it. Number two, I mean, you can't build you could go out and build an A-class property, but you can't build a C-class property, right? Or nobody builds C-class properties. And not that you can't build one, but nobody does. The economics don't make sense. But now I think there's a play to be made in the A-class as well, because construction is halted.
Yeah.
So you look at a market like Houston, or like even here in DFW, I mean, how many projects have been sidelined, or maybe not started, or just delayed? And now these new inventories are going to come on, instead of in 2021, they might not come in until 2023 or something like that. So I think the fundamentals of multifamily are super strong.
And it's not just the product grades like I've talked about many, many times, and you predominantly historically focus, like you said, on workforce housing. So your C class and your B class, but it's not just that, but it's like the geography, like where are you putting your investment dollars to work? And the markets you mentioned, Phoenix, Atlanta, Texas, Florida. Those are high growth markets. Those are population immigration, job immigration markets, landlord friendly, business friendly. I know that's part of what you teach is kind of a successful recipe is investing in markets like that, not in California, not in New York. But it seems like the virus has really kind of accelerated these trends that were already going on, and the migration of jobs and people are going. I mean, in Texas alone, we in the last month or so of 2020, it was Oracle, it was HP. Tesla moved there as well. So all these big corporate reloads were coming from California to Texas, and the jobs and the money and all that's going to flow here, which will kind of further drive the demand for what we do, which is housing, which is pretty great. If you do see a risk in the marketplace, what I don't know if it keeps you up at night, but what do you kind of think about as kind of the biggest risks as we're kind of entering 2021 right now?
Yeah, I mean, I think the biggest risks are things that unfortunately are things that we don't have control over, and one is the political climate. It's the election is well, I believe the election results are clear.
Yeah.
I'll also state that it's not how I would have wanted it to go.
Yeah.
And that, I think that Trump would have been better for real estate investors, just for the business climate and the taxes. But I mean, look, I've been doing this since 2002, made money under Obama, made money under George W. Bush, did great under Trump, and we're going to do great under Biden.
Yeah.
But there's still some uncertainty. Like, what's Biden going to do? Is there going to be more, just in December of 2020, another stimulus package was passed.
Yeah.
Now Pelosi's already saying, well, there's going to be another one in March. This is just the beginning. Wait until January 20th, which is in a few weeks away. Is there going to be another stimulus package? Is there going to be any rental assistance?
Yeah.
Is there going to be another eviction moratorium, which, by the way, has had minimal impact on our operations? But so the whole uncertainty as far as, well, what are they going to do and how is it going to impact our business? That's a remaining risk. And I think the other that coincides with that is just the pandemic. Are we going to have 4 years of masking and social distancing and virtual business, or are we going to get back to normal within a few short months? And again, my preference is that we get back to normal in a few short months, and I'm not bashful about saying that. But so those to me are the main risks. But the risks are, for me personally, and I want to be able to say this, I'm doubling down right now. And one of the mistakes that I made in the past is being a little too conservative on my acquisition strategy. So I'm doubling down. I'm putting my money where my mouth is. In December, I just closed a 13 unit, a 13 million dollar, 152 unit property in Fort Worth that I bought mainly with just my wife and I and a few other investors. And, that deal is a great deal. And I'm sure, I'm doing my first $100 million deal that's closing in just a few days. So it's $122 million in Houston. It's A-class. It's the biggest property I ever bought. And I'm personally putting $800,000 of my own equity into that deal. So I believe, and my mentors believe, the people that I hang around with, by the way, I hang around with people like you. I hang around with people, that have 10, 15, 20,000 units. And most of these people are doubling down right now because they know the industry, they know the market cycles, they see the trends. And we're not doing that in every market, like you mentioned, but we're doing it in markets that make sense. We're doing it in Dallas, we're doing it in Houston, we're doing it in Tampa Bay area. You look at the migration patterns.
Yep.
You look at where people were moving to, you look at where jobs are being created, and there's a shortage of housing in these markets.
One of the things I struggle with, I know you do as well, just trying to make sure that you're entering the market at a good time. But I heard a quote a long time ago, which I kind of reheard it again here recently from Warren Buffett. It's not so much about investors shouldn't worry about timing the market. It's more about time in the market. And that can be never more true than in what we do investing in multifamily. Time cures a lot of these problems or mistakes, or you just wait long enough. If you're in the path of progress, you're in these markets like we talked about, you fundamentally set your business up right. I mean, the rent always goes up. I mean, over long periods of time, rent goes up. There's inflation that comes in and really kind of helps it out. And then my tenure of doing this has certainly been the case. We've had the wind at our back, and it's been an unbelievable run. So I mean, I echo a lot of what you're saying. We're trying to be even more aggressive. We bought over 10,000 units in my career now. We're trying to buy. I wish I would have bought more, so we're going to try to continue to buy more. Kind of as we start wrapping up here, maybe another way of asking that last question. You talk to a lot of first timers. What are some fears that people have that you think are kind of misplaced when they're afraid of buying a deal or afraid of the marketplace? What are some of the misplaced fears that you kind of hear commonly?
Well, the two big ones, and they go hand in hand, are the price per unit and the cap rates. Price per units. Oh my God, you're paying, $85 a door, $100,000 a door. But like you said, and we were talking, I mean, the property that we bought 8 years ago for $30,000 a door, the rents might have been $450 a month, and now they're $880 a month.
Yeah.
So if you just do the numbers, right? And you take the rent times 12, and you look at the income. I mean, the incomes are up by the same factor as the price per door. So that $30,000 a door property that's now selling for $90, you're getting similar returns.
Yep.
The other thing in our favor is that interest rates are so much better. So 8 years ago, buying that property for $30,000 a door, we were getting a 6% interest rate.
Amortizing.
Yeah, no interest only. I mean, if we can get, like, my first deal I bought in 2002 was 6.4% at $30,000 a door. Now this was 18 years ago, right? But I mean, now that deal might sell for $80,000 a door, but you get a sub 3% loan, maybe interest only for 3 to 5 years.
Yeah.
So your rate of return, your cash return, potentially is even better now than it was before.
Yeah.
So I don't look at price per door and acquisition cap rate. I mean, I look at them.
Yeah.
Whenever I'm saying these things, you know what I'm thinking, Mike?
What's that?
You know how the politicians, they take sound bites and cut them off? Like somebody could take a sound bite and say, I bought a 13-unit property.
Yeah.
I don't look at cap rate. Well, of course I look at cap rate.
Yeah.
But I don't look at it as much as maybe other people. And I think that at the end of the day, what you want to look at is every deal I do, I analyze based on a 5-year hold with a sale at year 5. So I have an apples to apples comparison.
Yeah.
And I look at what is my cash return, what is my sales proceeds, what is my tax savings.
Yep.
And I have a really simple property analyzer that just helps me make decisions based on return.
Yep.
And then the 152 unit deal, not 13 unit, but the 152 unit was 13 million that we bought. And this is just a good example. I was presented with 2 different debt quotes, and one was had higher loan proceeds, but it only had 2 years of interest only.
Yep.
And the other had about $1 million in lower loan proceeds, but it had 5 years of interest only.
Yep.
So if I was tight on equity, I would have went with the higher loan proceeds.
Sure.
But because I have equity sitting in the bank that's earning nothing,
Yep.
I went with the program that gave me 5 years of IO because the cash return was higher, the 5-year internal rate of return was higher, the total return was higher.
Yep.
So by every metric, the return was higher to get maybe a little bit lower loan proceeds and have that 5 years of IO.
So besides looking forward to maybe buying some more assets personally, what else are you looking forward for 2021? What's on the horizon for you and your program?
Well, 2020 was a pivotal year. As you know, our program historically does live training events.
Yep.
Just think Tony Robbins and all these
500,
other people that do
600 people
training
in a
events,
hotel
right?
ballroom, right? That's what you historically have done.
3 to 5 times a year would get 500 to 800 people. Our largest event was 1,100 people when we bring in national speakers,
Yep.
right? And so we obviously went to a virtual model. And I think we've been real successful in that. And we learned what to do and what not to do. And we learned how to deliver our content and add value virtually. And at first it scared the crap out of me. But now it's actually fun. And we could we found a way where we could interact with people from their homes and deliver the same, or maybe, and I don't want to say a better experience, because the live events are an amazing experience,
Yeah.
but we're able to bring a great content and a true interactive experience, which transcends a typical Zoom meeting.
Yep.
Okay, so nobody wants to watch an event on a Zoom format for 8 hours, 2 or 3 days in a row.
Yep.
And so we've been able to figure out, well, how do we bring people in using technology but make it more interactive, as if they are in a seminar room.
Yep.
And so that's what's coming for 2021. We're gonna continue to do that. And even if and when things get back to a timing where we can do live events, we will be. In fact, we did a live event in December of 2020 to finish off 2020. But 2021 will be a combination. We'll be doing live events and we'll be doing virtual events. So that's one of the things I'm excited about. Just like in multifamily, like leasing, right? People went from doing physical leasing tours to virtual tours. Well, that's here to stay.
Yep.
So the virtual stuff is here to stay, but now the game is how do you make that virtual experience, for lack of a better term, how do we monetize it?
Yep.
How do we make it just as profitable as a live event? Or how do we, in the apartment business, how do we have a virtual leasing experience have the same conversion rate as an in-person leasing experience? Yep. And I think that's where we're at right now in the industry.
So Brad has been doing this a very long time, known Brad a very long time. I've personally seen numerous people that have taken his program, started with zero experience, learned what they needed to learn, formed their relationships, and become very, very successful doing multi-million-dollar deals, repeatedly. So I've personally seen them with my own eyes. So certainly, if anyone's looking forward to maybe learning a little bit more about this business, or wanting to kind of aspire to be like me one day, kind of form a company, start it and buy larger scale deals, I would certainly encourage you guys to look up Brad, reach out to him, try to maybe take one of his introductory programs and see if this might be a fit for you or not. Brad, if people want to know more about you, find out more information about how they can learn how to work with you, what's the best way? Maybe give the viewers a couple resources. Yeah, well, the best way is to go to bradsumrock.com. And there's no C in my last name. Yeah. So it's BRADSUMROK.com. But I'll also like to say, Mike, and all due respect to, many other programs out there, unlike yourself or some other people, I don't have a podcast, not yet. I've been thinking about it for years. But another way to find it is if there's so many podcasts out there that interview people that kind of started out and did their first, second, or third deal. And the vast majority of those people on other people's podcasts are actually my students. And that's been a win-win for them. They come into my program, they get a lot of success. And one of the things that I found out is that people don't just want to make money. People want to be the authority. People want to be famous. People love being famous. People love being well-known. And so not only are my students out there making, we've helped over 190 people increase their net worth by $1 million. Since I started tracking it. Yep. But not only that, many of them have been sought after to be, speakers at events and guests on podcasts and stuff like that. So we're not just helping people make money, we're helping people, hey, there's nothing wrong with wanting to be well known, right? And be famous. So yeah, if you watch other podcasts, a lot of the people being interviewed right now are my students. So you could track them down and ask them, how did you get started in the business? Did you have a mentor? Who was it? Was it the person that interviewed you, or was it somebody else? bradsumrock.com. And then, of course, we do a lot of advertising and Googles and things like that. And but that's where the best way to find me. So just go to bradsumrock.com with no C. So for Brad Sumrok, I'm Michael Becker. I appreciate you guys watching. We'll see you guys next week.
Follow the Multifamily Investing Show on Facebook, YouTube, LinkedIn, and your other favorite podcast platforms. To learn more information about investing with Michael, please go to www.multifamilyinvestingshow.com.